All right, happy new year, happy new decade. I know there's some debate about whether it's really a new decade or not, but we're just going to go with it today as a new decade. So excited to have you guys here with me to talk about all the ASUs you need to be thinking about for your calendar year ends, but also if you have a June 30 year end, these will be the ones that are coming through. So as we go through, we'll talk a little bit about what that means for everyone. So today, my name is Melissa Galasso, and I'm a director at Cherry Beckert out of their Charlotte office. So super excited to be able to talk to you about all things related to these ASUs. So today, your learning objectives are to be able to list the ASUs that will be effective for 2019 year ends and describe the impact of these ASUs on financial statements. Today, we're going to do a very high level. We're going to focus on what I would call an executive overview. We're going to introduce you to the standard, and then it's going to be up to you to decide whether or not it applies to you. If it applies to you, then you probably want to potentially read the standard. It's really good bedtime material, or to take a course on a deep dive into one of the standards that are impacting you. Hopefully, not every standard will impact you because that would be a lot of work to adopt all in one year. But a lot of these are very niche areas, and so we're going to cover all of the ones that are effective, and then you can decide which ones you need to know a little bit more about. So let's get started here with our very first polling question. All right, so in our first polling question, just to give you a little, sense of the new year, did you set a New Year's resolution? All right, so that is our question for you. Did you decide to set a New Year's resolution? So I am not a New Year's resolution type person. I go with a word of the year. And so last year, my word was flourish, and I had an amazing year, a very great year for my business as well as for the work I do with Cherry Beckert. So super happy there. And then this year, my new word for 2020 is going to be build. So I'm excited to see what 2020 brings. And looks like many of you are here with me in not setting a resolution, maybe potentially setting just an intention or a word of the year. So let's close out this poll. It looks like about 53% of you did not set a resolution for 2020, although 47% of you did. So we are pretty much at that breaking point for many people. We are 9 days in to the new year. So if you did set a New Year's resolution, I hope you're holding strong to it and that you are successful in whatever that might be. All right, so let's dive on in here. We're going to start with non-public entities. These are things that if you are a public company, you probably implemented last year because that would have been your effective date. But for those of you who are from non-public entities, this would be the year for you to adopt. And the first ASU of the year is going to be ASU 2016-01, Recognition and Measurement of Financial Assets and Financial Liabilities. And so this is part of the 2008 financial crisis response. It is part of a much larger grouping called the Financial Instruments Suite. And you can't see my PowerPoint. That's odd. All right. There we go. Hopefully, did that fix it? Got it. All right, excellent. I have my helpers here trying to make sure that we are successful. So 2016-01 is part of the bigger financial instrument suite of standards. There are 3 of them. ASU 2016-01 was the first one. It was followed by ASU 2016-13, which is the ASU 2016-13, which is the new CECL model, and then ASU 2017-12, which is the hedge model. And so as a result, they were issued separately, but they're all part of this bigger response to the 2008 financial crisis. And when you're looking at this ASU, you're going to notice a couple of big things. The first one is the codification changes. The current codification has one topic, topic 320, and it covers debt and equity securities. Under the new methodology, topic 320 is renamed to just debt securities, and it creates a new topic, topic 321, for equity securities. Now, why is that? Because debt securities are not changing. Debt securities will still retain the current GAAP classification, trading securities that are fair value through net income, available for sale, which is fair value through OCI, and held to maturity, which is shown at amortized cost. There will be no changes there. But what you do see going forward is changes to equity securities, which is why they're in their own codification section now. And when we do that, we're going to recognize all unrealized gains and losses for equity securities through net income. There will be no OCI component. We will no longer classify equity securities as available for sale or trading because they're all going to run through net income. So this may create some volatility for your financial statements because you're not able to smooth the transition for those unrealized gains and losses for those equity securities in OCI. Everything will run through your income statement. If you're a nonprofit, obviously this is not going to impact you because they don't have OCI. The other thing that is in this standard is a new OCI item, and that is what we call instrument-specific credit risk. And this is when an entity elects what we call the fair value option. And the fair value option is exactly like it sounds. The liability should be or can be treated under another accounting, typically amortized cost basis, but you elect to value it at fair value. So it's an option to use fair value over the typical methodology. And historically, when you elect fair value option, the general rule is that you would run all changes in fair value through net income. What ASU 2016-01 does is it has an exception to that rule, which is when you have instrument-specific credit risk, it will be presented in OCI. So you will actually take the change in fair value and separate what's the change in the market from what's the change in the instrument. The instrument portion will run through OCI. The change in the market will run through net income. So we'll get a new OCI item as a result of this. There are some other changes in this area. They do have new impairment analysis for equity securities that do not have a readily determinable fair value. That is because the cost method has been removed. So we used to use cost method. Now, if you have an equity security that doesn't have a readily determinable fair value and it doesn't meet the exception for NAV, then what we're going to do here is we're going to take cost and we're going to adjust it for changes in fair value related to observable price changes from orderly transactions for either identical or similar investments of the same issuer. So as a result there, you also can have some changes to OCI as they remove that concept of other than temporary. Only accountants would call something other than temporary. Normal people call it permanent, but we're always afraid that it's not truly permanent, so we called it other than temporary. So that creates, again, some changes to OCI. So those are the big things in there. There are also some disclosure benefits for non-public entities. Under the prior standard, you would have to disclose the fair value of something, even if it was on the financial statements at amortized cost basis. You were required for those financial instruments to also provide disclosures related to fair value. That is removed in ASU 2016-01. So always some good items there. So 2016-01 is a pretty big undertaking for most entities. So definitely something that you want to be paying attention to as we go through it. As this is a large undertaking, it also had some what we call amending ASUs. So ASU 2018-03 and ASU 2019-04 make amendments to ASU 2016-01. So when you are adopting this, you do also want to review these ASUs for some of the technical corrections and codification improvements. So this was effective last year for public, this year for private, which includes not-for-profits and employee benefit plans. The next standard is ASU 2016-04. Sometimes I cover this simply by mentioning it in revenue recognition, but I did want to just make one quick point about this because some people get confused about why 2016-04 is related to revenue recognition. And that is because it's related to what we call prepaid store valued products. Normal people call those gift cards. When we think about this, it's basically you have purchased a $25 gift card to a store. That is a prepaid stored value product. And when you do that, gift cards are actually a financial instrument. Well, financial instruments are scoped out of revenue recognition. However, one of the things that happens, I have a little kid, she's not as little anymore, so she actually recognizes the value of a gift card and she gets excited about gift cards. But when she was little, if she got a gift card for Christmas or for her birthday, it went into the pile of wrapping paper because it wasn't, in her opinion, a gift. And so I can't tell you how many gift cards we received over the years that after we cleaned up the party, we couldn't actually find them. And in that scenario, the company, when you bought that gift card, debited cash but credited a liability. They have to then provide you with a good or service. Well, if you lose the gift card, then you're never going to cash it in. And eventually they want to recognize revenue for that. And that is called breakage. And the question was, when can I recognize breakage? Well, we have the concept of breakage in topic 606, except financial instruments are scoped out of the standard. So ASU 2016-01 basically allows us to apply the recognition of the dollar value of these cards, even though it's a financial instrument, using a process consistent with topic 606. So even though financial instruments are scoped out of the standard, it gives us this narrow scope exception to follow the 606 guidance for breakage for these financial instruments. So public companies would have adopted this last year when they adopted revenue recognition, and now it's time for private companies to do the same. Next up is related to the cash flow statement. We'll actually have two standards today related to the cash flow statement for private companies. And I think this is just because when the FASB issues an ASU, they very rarely indicate what the accounting is for the cash flow, right? They will tell us what the balance sheet recognition is. They'll tell us what the subsequent recognition and measurement is for the income statement, but they never say, and by the way, this is an investing cash flow. Right? There's not that guidance at the ASU level. And sometimes that leads to what we call diversity in practice, where different people interpret the transaction differently, and then we don't have consistent treatment between various companies. And the only way to reduce diversity in practice is for the FASB to come out and give explicit guidance. And that's what they have done here. So the first thing that they address is debt prepayment or debt extinguishment costs. Some people were treating them as operating activities, saying they were aligned with interest, but FASB said no, they're really like the payment of debt and therefore should be a financing activity. So more like principal in that scenario. The settlement of zero coupon debt. Some people argue that if it's a zero coupon rate, that therefore it has no stated rate, therefore no portion of it is cash flow related to the interest and the whole thing should be financing. FASB disagreed because, as you're probably aware, we require the use of an effective interest rate when we're doing the accounting. So the portion that was accreted as interest is going to be treated as an operating cash flow for the cash flow statement, and the portion that's related to principal would be treated as a financing activity for that purpose. So ASU 2016-15 just kind of clarified and reduced that diversity in practice. Contingent consideration payments made after a business combination. In this scenario, it really depends on what's happening. Very often, if I'm selling my company, I might have these payouts that happen well after, right? So if you hit a certain income target or you retain a certain number of customers, right, I might continue to receive payment even after the business combination. And so what the FASB looks at is timing. If a cash payment is made what they call soon after the acquisition date, then that's going to be an investing activity, that outflow. Now, reminder here though, when you're doing this, they don't really define the term soon after in the actual codification. However, if you read the basis for conclusions, they do talk about like a 3-month period. So it's sort of, you want to make sure you're also kind of considering what does that mean to be soon after. If the cash payment is not made soon after, then the portion that's up to the contingent liability would be a financing activity, and anything in excess of that contingent liability would be an operating activity. So it could be financing or operating or investing, depending on the timing of the payment, as well as the amount that you had included as contingent consideration liability at the acquisition date. So lots of options there. Insurance was another area where there was confusion. Some people argued that when I pay for my insurance, it's an operating activity. Therefore, any proceeds I receive back when I have a settlement of a claim should therefore have to be an operating activity. And FASB disagreed with that. They said you should look at your nature of your loss. So if you have an inventory fire, yes, we can get comfortable with an operating activity. But if it was machinery that was damaged, then you probably should be recognized that as an investing activity. It even goes so far to say that if you have a lump sum, so maybe your entire facility burns to the ground, in that scenario, you're going to get a lump sum payment. You still have to look at the basis of each loss in the settlement in order to allocate it for cash flow purposes. So they do provide some pretty consistent questions for people to handle. All right, next up here, there are just another handful of items. The first one are what we call COLIs, or corporate owned life insurance. This is when the company takes out life insurance on its key employees, typically the CEO or CFO. And in that scenario, some people were arguing that they only take it out on their chief executives. And so as a result, it should be an operating activity. FASB disagreed and indicated that the cash inflow from any COLI proceeds, if you had a settlement, would be an investing activity. And if you think about it, 9 times out of 10, the reason why you are buying these COLIs are the tax benefit, right? So as a result, this would be an investing activity. However, oddly enough, they did tell us that the premiums for COLIs could be investing, operating, or a combination of both. So they were not as picky about the proceeds, or sorry, as about the premiums as they were about the proceeds here. And that makes sense, because typically if you're going to take out insurance on a key employee, it's going to be a pretty big number, whereas your premiums hopefully are a pretty small number. Equity method distributions, we have 2 options here. We have what they call the nature of distribution approach, and we have the cumulative earnings approach. I'm a big fan of the cumulative earnings approach, and the reason why is the nature of distribution approach basically says that once information is no longer available to the investor to be able to discern the type of payment, you would have to switch to the cumulative earnings approach using a change in accounting principle. And to me, I would just rather use the cumulative earnings approach instead of having to worry about having to do a change in accounting principle later. Now, why do I also like the cumulative earnings approach? Well, it's a general rule. The general rule is that any cash inflows when you have dividends from your equity method investees are just going to be operating activities, except, because for every general rule we have to have an exception, when the cumulative distribution received exceeds your cumulative equity, right? In that scenario, it would switch to be an investing activity. Now, again, this only applies if you're using an equity method for your equity method investees and you haven't elected the fair value option. Another area that they address in the standard is what they call beneficial interest in securitization transactions. This is when you have a transfer or sells some type of financial assets, very frequently accounts receivable, to an unconsolidated securitization entity in return for cash and a beneficial interest. Well, when you do that, that beneficial interest obviously is not cash, but is required to be disclosed as a non-cash activity. And then any cash receipts from those payments on the transfer's beneficial interest would be an investing activity. And so ultimately, FASB said, we don't really like writing these standards about cash flow. We think you should just follow the rules that we have. So they come and they give us what they call the predominance principle. And the predominance principle says, first, you should apply the specific information in GAAP. So if we gave you a rule, please follow it. However, if we didn't give you a specific rule, then you have to look at each separately identifiable source or use within cash receipts and cash payments, and then look at the underlying cash flows to determine their nature, right? So you would classify based on the nature of the cash flow. However, if you have more than one class of cash flows and you can't separate it by source or use, then you would look at the predominant source or use of that cash flow. Do I think this is going to solve our problems? No. And honestly, the reason is most people did consider the nature and just came to a different conclusion than what FASB came to. So it's not like they were trying to do it wrong. They just had a different interpretation. And so I don't think this will solve the problems. I think we're going to have more cash flow standards to be coming out in the near future. So this is something public business entities did last year. It is private companies terms. Everyone has to adopt it all in the same period. So you can't piecemeal the adoption of this. ASU 2016-16 is a pretty niche area here, and this is when we have intra, meaning within, an entity transfer of assets. So a great example would be a parent company sells some PP&E to a sub, right? So a parent sub transfer, that is within the same entity for reporting purposes. And the reason why the standard came out is that FASB's been working on the simplification initiative for some time. And one of the things they're trying to do is to eliminate some of these exceptions to the rule, right? We have these rules and then there are like a zillion exceptions to the rule. And that's exactly what exists today, right? Current GAAP prohibits the recognition of current and deferred income taxes. And again, this is only for income taxes when you have an intra-entity transfer of an asset until it's been sold to an outside party. Well, that violates our concept of comprehensive recognition, and it's an exception to the rules in GAAP. And so people have argued that it's costly to have these exceptions. So ASU 2016-16 helps eliminate that exception by requiring the recognition of the income tax consequence of an intra-entity transfer of assets. However, other than inventory. They did not eliminate the exception for inventory. So this applies predominantly to IP or PP&E. They decided not to change the GAAP for intra-entity transfers of inventory for two reasons. First, sheer volume, right? If you think about the number of times you're going to be selling inventory, right? That's going to be a significant cost to calculate that income tax impact. And second, really, inventory churns so frequently that hopefully it does get out to the outside third party rather quickly. So it's a minor timing difference. So that is one element here. Now, this ASU does not have any disclosure requirements. However, when you adopt the standard, you might actually have new disclosures because you'll have new current and deferred income taxes as a result of these transfers. So you might have an actual disclosure impact, even if you don't have any new disclosures required by the standard. So again, public companies did this last year, private companies are going to do it this year. Another cash flow item, this is one that I'm pretty passionate about. I think it needs some work, but it's a step in the right direction, which is ASU 2016-18 related to restricted cash. There's significant diversity in practice related to the cash flow statement on how restricted cash was shown in the cash flow statement. In fact, some entities did not include restricted cash at all in their cash flow statement because they felt like it was, normal cash that should be in the cash flow statement, things that move, not restricted cash. Other entities would put it as a non-cash item at the bottom of the cash flow statement just to show the transfers and the movement. Other people said, well, if it's restricted, it should be in investing activities. And other people were like, I don't know, cash is cash. It could be operating, investing, or financing. And so as you can see here, pretty significant diversity in practice as we look at the presentation of the cash flow statement. And so they wanted to clear that up. So going forward, the statement of cash flow is going to explain the change in cash equivalents, and this is what I don't love about the standards. It says amounts generally described as restricted cash or restricted cash equivalents. And why on earth are we using such weird language? That is because they could not define restricted cash. This came out of the Emerging Issues Task Force, and I think that they just really struggled with the definition. Things like deposits, HUD deposits, things of that nature was very contentious in terms of what was or was not defined. So they just went with amounts generally described as. So the FASB thinks this is easy to adopt because it's based on your definition, but that just ultimately leads to problems with comparability. So I personally would like to see them come up with a definition of restricted cash, given that the title of ASU 2016-18 is restricted cash. Now, as a reminder here, depending on how you currently do your cash flow statement, you might also need an additional disclosure. So I'd like you to think about a company that has a line item on their balance sheet called cash and cash equivalents. Most people would assume that that line item ties to the cash flow statement, but now you have to think about a company who also has a line item called restricted cash. Or perhaps they have restricted cash buried in some other asset account. Well, now in your disclosures, you would have to reconcile your cash and cash equivalents line item plus your restricted cash line item plus your restricted cash included in other assets to come up with your total cash, cash equivalents, and restricted cash, which is what's going to be reconciled in the cash flow statement. And the user, especially for those that are buried in other asset accounts, wouldn't know about that money if you didn't have that disclosure. So that is an additional requirement here. And then finally, transfers. Because restricted cash is going to be in the cash flow statement, if you transfer money between a restricted cash account and an operating account, that is not a cash flow because money didn't come into the company or leave the company. So as a result, 2016-18 reminds us that transfers between cash, cash equivalents, and restricted cash are not cash flows for the purpose of cash flow statement. So this is effective last year for public companies, this year for private companies. Many of you look at ASU 2017-01 and are like, what do you mean, the definition of a business? Clearly, I know what the definition of a business is, but really the problem that they were trying to fix here is that the definition of a business in topic 805, which is business combinations, was being applied very broadly. People thought they were entering into an asset acquisition only to find out that that acquisition met the definition of a business acquisition. And so instead of getting easy accounting on an asset acquisition, they ended up having to do goodwill calculations, et cetera. And so people found the cost and complexity related to the definition in 805 was very difficult for them to apply. And so the FASB really addresses this well, in my opinion. They provide a screen to determine when, by definition, a set is not a business. And so the screen tells us that when substantially all of the fair value of the gross assets either acquired or disposed of is concentrated in a single identifiable asset or group of similar assets, by definition, that set is not a business. And so as a result, those asset acquisitions should get scoped out based on this screen. Now, unfortunately, not all assets are going to meet this because not everything is really a group of identifiable assets that are similar. And so as a result, if the screen is not met, then you would have to continue. But hopefully the screen should reduce the number of transactions that need further evaluation. However, if the screen is not met, they also make it a little bit of a change here that in order to be a business, you have to have an input and what they call a substantive process that creates the ability or that contributes to the ability to create an output. And I think that's really important, that concept of a process. We do not require under US GAAP that a company actually have an output. And I think a lot of people are surprised by that because most companies do have an output. They have a good or a service that they provide as part of their business. But there are companies like R&D companies that don't yet have their output. They're working on their output, and we would still want to treat them as a business. And so as a result, this screen helps to clarify what is really a business. The other thing that this does that I think is awesome is that it removes the requirement to evaluate whether if there's a missing element that you could replace it in the market. Because under the prior standard, there was a concept here, which I think used to really confuse a lot of people, which said that if you are, if you could replace something, if you were missing something in this acquisition, but you could simply go out and have someone else, you could go out and replace the element that was missing, it would still qualify to be a business. This says if you're not getting everything to be a business, you're just not a business. So I have, a lot of people really like this standard because it does reduce the number of things that should qualify to be a business. So it's not perfect, but it's definitely a movement in the right direction. So again, public companies have already adopted this. Private companies and not-for-profits and employee benefit plans will be adopting it for this calendar 19, fiscal 20. All right, next up here, this one is also really related to revenue recognition. I just wanted to call attention to it, but it really is part of the revenue recognition guidance here, and that is ASU 2017-05. If you look at ASU 2014-09, which is the new revenue recognition, right, revenue from contracts with customers, one of the things people tend to focus on is that ASU 2014-09 creates topic 606. But what they forget is that ASU 2014-09 also creates topic 61020. And in topic 61020, it addresses when you're not selling to a customer. So if you are you have to, under revenue recognition, under 606, it has to be revenue from contracts with customers. So if you're not a customer, you're going to be in either 810 or 610 for that sale. And when they wrote topic 61020, they used this term in substance non-financial asset. However, they never defined the term in substance non-financial asset. And so people wanted to have more understanding about what that meant. So the whole point of this standard is to provide a definition of an in substance non-financial asset, which is a financial asset where substantially all of the value comes from a non-financial asset. And so that's sort of the definition there. Once you're in there, then you're within the scope of 61020, not topic 606. So again, that is for public business entities when they adopted revenue recognition last year. Everyone else will do it this year. Now, we don't have a lot of companies out there anymore today, commercial entities that have pension plans. There are a lot of companies out there that have pension, or a lot of governments out there that have pension plans, but not as many companies, commercial entities anymore. However, if you are a company that has pension plans, one of the things you have to calculate is net periodic pension cost. And there are 6 components to net periodic pension cost. And when I teach them for Becker, for our upcoming CPAs, we teach them as SIR age, service cost, interest cost, your return on your planned assets, your amortization, your gain or loss, and then your existing transition asset, right? So SIR age is the mnemonic, SIR runs through net income, AGE runs through OCI. That's all we really have in terms of guidance for presentation purposes for net periodic pension cost. And so as a result, there was diversity in practice related to how we presented that item. So now ASU 2017-07 clarifies that only the service cost component should be shown in compensation. The other 5 components, when they hit the income statement, need to be in a subtotal outside of continuing operations. Outside of income from operations, not continuing operations. So they're just non-operating items. So the IRAGE are going to be shown outside of income from operations. The S is going to be in a compensation cost line item. And so now they've kind of clarified the location of that. In addition, if you are using a separate line item to present that other component, then just make sure that it's appropriately described and the user would understand it. However, if you're not using a separate line item and you're kind of combining it with other stuff, then you want to disclose somewhere in the notes what line item you are kind of burying those other components in. And then last but not least, ASU 2017-07 requires that only the service cost component be eligible for capitalization. You would not be able to capitalize any of the other elements of net periodic pension costs going forward. So this is effective last year for public, this year for private. All right, excellent. Nope, we're going to get to our next check-in in a second. So for those of you who are concerned about our check-ins, it's coming at the next break. All right, excellent. So the next one is also related to revenue recognition, and this is related to the service cost, determination of the customer in a operation service. And this really deals with service concession arrangements. And service concession arrangements are in topic 853. And the only thing that this standard addresses is who is the customer. Because again, remember, topic 606 is revenue from contracts with customers. And the question was, and I have a service concession arrangement like a toll road, right? The government is the grantor and they are the person who has the contract with the private company to run and operate the toll road. But the company is paid by the third-party drivers who drive on the toll road. And the question was, well, then who is the customer? Is it the third-party drivers who are paying for it, or is it the government who is the person who enters into the contract? And the answer is, in all cases, the grantor in the service concession arrangement will always be the customer if you're within the scope of topic 853. So that's just a clarification of who is. If you hadn't adopted 606, you would adopt it with topic 606. If you had early adopted 606, you were scheduled to do that at the time that you would have adopted 606 if you hadn't early adopted. And then last but not least, ASU 2018-08 for our private companies. Now, Chair Beckert has done several webinars on ASU 2018-08. So if you are in a nonprofit and you are adopting the standard, I would highly recommend that you take a look at our 1 or 2 hour classes on this, because I'm going to give it about a 2-minute spiel, but it's really very complicated. And so I would highly recommend that you take a look at one of our classes. Remember, all of our webinars, once we have done them live, are put on the cbh.com website, and you can watch them anytime. You just can't receive CPE for them. So that's the one catch there. So while you are able to watch them again or send them to somebody, if you said, oh, this would really help you, we're happy to share the knowledge. We just can't give you CPE for those items. So there's 2 things that are addressed in topic in ASU 2018-08. The first one is whether a grant or any other contract is a contribution versus an exchange transaction, because obviously topic 606 puts additional scrutiny on exchange transactions, then we really wanted to make sure that we were consistent. So they updated the indicators. They clarified, for example, that a resource provider is not synonymous with the general public. They also clarified that execution of a mission or positive sentiment is not commensurate value. They also provided us what they call the third-party payer exception to indicate that topic 606 would apply when there is a third-party payer. Once they were in there, they also decided to address contribution accounting, and they changed the definition of a condition. So going forward, in order to be a condition, you must have a barrier that must be overcome and a right of return or right of release, right of return or right of release. So you have to have a barrier, and then a right of return or right of release. You need those 2 things. And a lot of people were confused as to what do they mean by the term barrier. So they gave us 3 indicators of a barrier: a measurable performance-related barrier, the extent to which the stipulation limits the discretion by the recipient on the conduct of the activity, and whether the stipulation is related to the purpose of the activity. So those 3 barriers help us, or those 3 indicators help us identify whether we have a barrier and then have by definition, a condition. So that will have a material impact on many nonprofits in terms of the timing of their recognition for those contributions. So this one's a little different because it has 2 sets of effective dates. The first one is for the resource recipient. So this is the person receiving the grant or the contract or the resources. If they're a public business entity, including nonprofits with conduit debt, they would have done this for June 30, 2019. Everyone else would be doing it for December 31st of 2019. If you are the provider, however, you got an extra year. So nonprofits with conduit debt and public companies would have December of 19, and then everyone else would be calendar 20. So those are the sort of effective dates in that section. All right. Now, obviously, revenue recognition is effective this year for our private entities. I am not going to go over ASU 2014-09. We have 8 different ASUs that are all impacting revenue recognition. So ASU 2014-09, 2015-14, 2016-12, 2016-11, 2016-10, 2016-08, 2017-10, 2017-13, 2017-14, all apply to revenue recognition. And we've done a bunch of opportunities for you guys here. So this is just your reminder that this standard is effective, but we are not going to remotely attempt to try to go over that. So let's take a look at our next poll here. And the question that I have is, what type of company do you represent? Are you from a government, nonprofit, private company, or public company? And you guys are coming out exactly as I thought. So this just helps us to understand who's attending our webinars and at what level of detail do we need to go through them. So this is just really useful information here. Looks like most of you have voted. I'll just give you a couple more seconds to get your poll in place. All right, let's close that poll out. So it looks like only 12% of you are coming from public, 43% are from a private entity, 27% coming from nonprofit, which is very consistent with our attendance on webinars, and then 18% from government. That I am surprised by, because not covering any GASB standards today. We will do our GASB update. We typically do that in May. We usually cover them because most of our governments have either June 30 or 9/30 year ends. So we tend to focus on that in that May-June timeframe. But we always love to have you guys on board because sometimes governments actually have component units that are nonprofits who have to apply FASB standards. So a lot of times they will like to get the same education just to be on board. So thank you guys so much for that helpful information. All right, the next one we're going to cover here is what we call things that are impacting all entities. So these are not, they don't have different effective dates between public and private. They actually are, everyone's going to adopt them together. The first one is ASU 2017-06, which is related to employee benefit plans. So employee benefit plans, when you have a master trust, there was guidance in the standard that was different depending on what type of plan you were in. And so under this standard, what they basically do is they reduce that diversity in practice by requiring that each master trust where you have an interest is going to present the same information regarding the net assets available for benefits and the net assets, the statement of changes in net assets available for benefits. So we're going to bring consistency between those employee benefit plan sections. In addition, they remove the requirement to disclose the percentage interest in master trust when you have a divided interest. That was creating a lot of issue because if you have a divided interest, that disclosure was almost to some extent misleading. In addition, that prior to the standard, there was no requirements to disclose anything related to your other assets and liability balances. You're now required to disclose those balances and dollar amounts as part of the update here. And then for 401H plans, it used to be that you would have to basically repeat all of the investment information that was in the pension plan document in the health and welfare benefit plan. And so now it removes that redundancy and basically just say disclose, disclose the defined benefit plan where those investments are provided. So I think that's one of the big items there. So this again is effective for all entities for this year. And then steamship entities, I'm sure many of you are coming from steamship entities. If you are, there was some obsolete guidance in topic 995 that was being removed related to your deferred taxes and certain statutory reserve deposits. That standard is being removed because the law changed. And so they're just basically realigning us with the actual code here. So then again, that's for all entities. And then ASU 2018-02, which is the reclassification of our AOCI. So here, this one's interesting because the Tax Cuts and Jobs Act came out and it was unfortunately enacted, and that's the really important term here, on December 22nd of 2017. And I'm sure none of you have a fiscal year end that ends on December 22nd. It wasn't effective until January 1 of 2018, but it's not the effective date that matters for accounting purposes, it's the enactment date. And so as a result, that enactment date gave us a little bit of pause. And the FASB says that they received unsolicited comment letters. Normal people call that hate mail. And the reason why they started receiving these unsolicited comment letters is that under the rules in topic 740 for income taxes is when you have a change in your tax rate, that change in the tax rate actually flows through net income. And this has always been the case. This is not new. However, when they did that, the problem was if you had, for example, an unrealized gain or loss related to an available for sale debt security, the deferred taxes were being calculated through OCI, not through net income. So when you fixed the tax rate, so say you had a 35% tax rate and now you have the 21% corporate tax rate, that 14% flowed through net income, but it wasn't sitting in retained earnings. It's sitting in AOCI. So AOCI is misstated by the amount that you just fixed retained earnings. And so as a result, basically ASU 2018-02 gives us an option to reclass the AOCI amount into retained earnings for what they're calling the stranded tax effect resulting from the Tax Cuts and Jobs Act. So it basically allows us to do that. Now it is an option. You are not required to reclass. However, everybody has to adopt this standard because of the disclosure requirement. You must disclose your policy regarding the releasing of the income tax effects. If you do make the reclass, you must state that you did and then indicate the impact on your retained earnings and what was, the income tax impact for the reclassification. However, if you don't elect to, they want people to know that. So you would disclose that your election was not made to reclassify it and you hadn't adjusted AOCI for retained earnings. So again, this is for everyone for fiscal years beginning after December 5th, 2018, as you go through this. And you have a lot of options in how you do this. You can either do it in the period of adoption, which would be your 2019 year ends, or you can actually state it back into the period where the change was actually recognized as you go through it. All right, so here we go. Our next polling question, again, just to get some feedback from y'all in terms of our questions for you. How many ASUs do you guys think the FASB will issue in 2020? So they ended up only issuing 12 in 2019, which is almost a low. It's not the lowest that's ever been issued, but it was pretty close. We've been averaging 18, 19, 20 for some time, and in 2019, they only issued 12. So what is your thought? Do you think they're going to issue less than 10, between 10 and 20, or more than 20? What is your prediction here regarding FASB's prolific expansion of our ASUs in 2020? So as we start off the year, what are you thinking FASB will actually do? All right, looks like most of you have voted. I'll just give you one more second to get that vote in. All right, let's wrap this up. So 56% of you think that they're going to issue between 10 and 20. 37% think they'll issue less than 10. I don't think that'll ever happen, but I'm proud of you for guys maybe wanting that. So maybe you're like sending those vibes to FASB. And then 7% of you think they're going to issue more than 20. And I'll be really sad if that's true, but it is possible. They have done it in the past and it wouldn't be unheard of. So awesome. Thank you guys so much for sharing your predictions for 2020. All right, last but certainly not least, we want to hit our public companies. So our public companies also have some adoption this year. They have some small ones and some big ones. So it's like one of those years where they have to kind of consider this. Now, for those of you who are from private companies, don't tune me out quite yet, because some of these are really good early adoption options. So if you don't have a lot of things that you're adopting this year for your private company, you only have one or two and they're pretty minor, RevRec and a couple other things, you might want to consider potentially doing some early adoption here. So obviously public companies, very similar to our private companies. I'm not going to reiterate all the stuff that's happening with our lease standard. Hopefully you guys are doing the research there and you're getting pretty comfortable. Obviously Cherry Bekaert does offer some consulting services for the adoption of leases. And also we have some technology that you can use in order to adopt the standard. So if that's interesting to you, obviously reach out to your partner on your engagement or anyone on the PPD team, and we would love to talk to you about that. But those standards obviously are just massive. And as you can see here, also have significant number of amendments. So we would encourage you to be on the ball there. But what we're going to talk about now is ASU 2017-08, which is related to premium amortization on purchased callable debt securities. So what's going on here? Basically, an entity typically is going to amortize the premium on a callable debt security based on its contractual life, so basically to maturity. And when you do that, you don't consider the early payment of principal. And what happens when you do that is if it gets called, it creates a loss in the income statement because you have this unamortized premium at the call date. And people have argued that that's not really a loss, it's an accounting loss, right? Because that premium is an accounting concept. And so basically we fix that issue in ASU 2017-08 by shortening the amortization period for callable debt securities that are at a premium. So again, it has to be at a premium and it has to be callable. And if you have both of those, then you're actually going to amortize it to the earliest call date instead of maturity. So if it's a 5-year maturity, but it's callable after 2, the amortization period is now going to be 2 years. And so at that point in time, if it is called, it's going to be at par. And if it's not called, it's just going to sit on the balance sheet at par until it matures, right? So it kind of reduces that issue related to having that loss. This does not apply to securities that are held at a discount. Discount is going to continue to be amortized to maturity. So definitely make sure that you're only looking at this for those that are at a premium. Again, public companies have to do it this year. However, this is a great option for private companies to early adopt simply because it improves your income statement, right? So if we have something that's going to improve our income statement, most people would like to adopt that. ASU 2017-11 has two parts. So the title actually is a part 1 and a part 2. In part 1, we're handling specialty guidance related to down round features. So a down round feature is basically if I'm an early investor and I buy in at 10 and I have an option to purchase in the future, and then they run out of money and the company goes and issues new stock to another round of investors and they sell it to them for 8. As an early investor, I'd be really annoyed that I can only buy with my option something at 10 when someone who has less risk than me is buying at 8. And so as a result, a down round feature basically says that the strike price will automatically be reduced on the basis of any price or price changes in future equity offerings. So if I'm at 10 and then you sell for 8, my 10 automatically becomes an 8, and that's called a down round feature. Well, these are great protections for companies who are trying to go out there and get it, and their early investors are looking for it. The problem is when you have these features, you're first supposed to determine whether you meet the definition of a derivative. And if you do meet the definition, then the instrument, or if potentially it's embedded feature, has to be evaluated to determine whether it's indexed to its own stock. And that is one of the scope exceptions. Well, by definition, if you have a down round feature, you cannot indicate that it's indexed to its own stock, and therefore you're required to treat it as a liability when you determine if something is equity versus liability, equity versus debt. And people have argued that that's an artificial determination because when you think about fair value for that liability, fair value works going up and going down, whereas a down round feature only is one direction, right? When the price of the stock goes down in the future. If the price of the stock goes up on the next round, I am very happy because I can buy at 10 and the next round's buying at 30, right? I'm definitely not going to use that feature. So that was something that people really struggled with. And so to make it a little bit easier here, ASU 2017-11 says that a down round feature no longer will preclude equity classification when you're determining whether it's indexed to its own stock. Now, you still have to do a full accounting, right? You're not allowed to skip it and say, oh, it's automatically equity. You still have to look at all of the features, but it's just changing the fact that a down round feature is not going to be the only item there. In addition, there's some specialty guidance related to earnings per share, as well as if you have embedded conversion features, there's some specialty guidance on convertible instruments that you would want to take a look at in ASU 2017-11. Part 2 of this is really kind of interesting because part 2 takes what was an indefinite deferral, meaning they issued a standard and then they didn't make it effective. They said they'll be effective sometime in the future. And the only thing part 2 does is now say, you know what, it's just a scope exception. So it wasn't effective in the past, and now it'll never be effective in the past. So the impact on practice is nada. So nice, easy application there. You shouldn't have to do anything related to part 2. So again, this is for public entities this year, but if you're a private company with down round features, I highly suggest that you consider adopting the standard because it will generally have a nice positive impact on your accounting. Another area that we have here is related to hedging, and we have done a full-length course on hedging. So again, I'm going to do a really high-level review of ASU 2017-12, but if you go back out to this, Michael Hoos did a great job for Cherry Beckert covering all the intricacies to the standard. So hedging activities for ASU 2017-12 really have a couple of what we call simplifications. One of the big things that it does is allow what we call a contractually specified component. In the past, you had to, and anytime you did a hedge, you had to look at the total variability. You could not look at a portion of the variability. So, and if you had a change in the cash flow, you had to look at the overall variability for that cash flow. You couldn't look at a component. Under this new standard, it allows the hedging of risk components instead. As part of that, it adds a new benchmark rate, SIFMA. So as we look at reference rate reform, we know that we're going to be spending a lot of time with these new benchmark rates. Originally, we only had US Treasury rate, LIBOR, and the Fed fund swap rate, so the overnight index swap rate for the Fed fund rate. This adds another one with this, which is SIFMA, which is a municipal swap rate, as an eligible benchmark rate. The standard also focuses on presentation. So in the past, when we had this presentation, there wasn't a lot of guidance on location. So going forward, the earnings effect of a hedged instrument has to be presented in the same line item as the hedged item. So there's going to be more consistency in location. And there's no longer this concept of ineffectiveness. So now fair value hedge, 100% runs through earnings, and cash flow and net investment hedge, 100% runs through OCI. We no longer separate the effective from the ineffective portion for accounting presentation purposes. In addition, sometimes you will trigger what they call a quantitative initial assessment for your hedge. And in the past, once that was triggered, you were sort of stuck in quantitative measurement. Under this standard, if you are triggering initial quantitative testing, you may perform subsequent assessments using qualitative analysis. And so that's a huge bonus here. Other items include critical term matches, the timing of our documentation related to this. So again, lots of really cool things in here, and some additional amendments. So ASU 2019-04, this one does have some changes related to derivatives and hedging. So this is effective for public companies this year. Technically, private companies even get more time because ASU 2019-10 delays the effective date of ASU 2017-12 for private companies to 2021. ASU 2018-07 is related to stock comp, but not your traditional stock comp. This stock comp is actually non-employee share-based payment. And when we look at non-employee share-based payment, originally non-employee share-based payment was found in topic 505. However, topic 505 was not very encompassing, and the SEC used to say if it's not covered in 505, analogize topic 718. And so basically what 2018-07 does, it expands the scope of topic 718 to now include both employee share-based payment and non-employee share-based payment. So this is going to now align those instead of having different guidance between them. There will be better alignment. So super excited for entities who have this non-employee share-based payment. So public companies this year, private companies next year. Although if you're a private company with non-employee share-based payment, this is another great option. The next one and last one for today is ASU 2018-16, which is related to SOFR. So as you guys are probably aware, LIBOR is going away. And when it goes away, we need benchmark interest rates to replace it. And so because US GAAP has a requirement that we have these benchmark interest rates, when LIBOR goes away, the Federal Reserve wanted to have an alternative rate for the United States. And so they put together a committee and they decided on SOFR. Well, the problem was SOFR, which is the secured overnight financing rate, is not an eligible benchmark. So the only thing ASU 2018-16 does is permit SOFR as an eligible benchmark rate. In 2020, we expect to have full reference rate reform, meaning that the FASB will issue their standard that has all the information on how reference rate reform will impact entities. We don't have that yet. We had an exposure draft in 2019, but in 2020, we will cover all the information that we need for reference rate reform. So again, if you hadn't adopted 2017-12, you would adopt it with ASU 2017-12, which would be this year for public companies, and then you have some time for private companies. So last, but definitely not least, let's take a look at our last polling question of the day. And I was in a shop when I was writing this course. I was sitting there trying to get some PowerPoints done. And so I'm not going to tell you which one I was in, but which one would you rather be in? Dunkin' Donuts or Krispy Kreme, or are both just absolutely appalling to you? So Dunkin' Donuts, Krispy Kreme, or you just don't do donuts? All right, so that's our very scientific methodology we have going today. While we close out that poll, I do want to tell you that we have recommended others for early adoption. So if you're a private company, take a look at the VIE changes in 2018-17. If you're in the process of moving to the cloud, there's some really nice options for implementation costs related to 2018-15, so take a look at that. And if you're a private company, we like the new goodwill simplification, removing step 2 from your goodwill impairment analysis. So if you have to test your goodwill for impairment, predominantly public companies, 2017-04 is not effective yet, but might save you a considerable amount of time and money when it comes to your valuation there. All right, so let's close that poll. 92% of you have voted, and we have a lot of Krispy Kremes, and I'm not surprised because most of us are located somewhere in the South. I grew up north, and Dunkin' Donuts would have been the winner if we had included that. However, we do have some New Hampshire and some Texas and some other. The footprint for Tribeca continues to grow, so interested to see how that plays out. Well, again, my name is Melissa Galasso. It was a pleasure having you today. I've answered all the questions that have come in so far. And if there are any questions that I did not get to, I would be happy to email you the response. So thank you guys. And I'm glad some of you really enjoyed the survey question. I think that's glad it makes you happy. So happy new year, happy new decade. And I hope to see you on a future webinar. Have a great day, guys. Bye-bye.